Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets of big business a little too well. And let's just say Holcim's new North American child, Amrize, is trying to put on a brave face after becoming independent. Before we dive into the numbers, if you like getting the real story behind these glossy corporate reports, make sure you're subscribed and hit that notification bell. And hey, if you want to chat about this stuff with other finance enthusiasts, our Discord community link is in the description below, so join us. This filing is from Amrize Ltd, a company that not too long ago was just a part of the global giant known as Holcim, but in June 2025 they officially went their separate ways, becoming their own independent entity. This report is basically their second wave of public financial statements as a standalone company, giving us a peek into how they're doing since cutting the cord. Let's get straight to the heart of it, the financial performance. When we look at the revenue for the first 6 months of 2025, Amrize brought in about $5.3 billion. Now compare that to the same period in the previous year, 2024, when they were still under Holcim's umbrella and had revenues of around $5.4 billion. So a slight dip of about 2%, which isn't ideal, but for a newly independent company may be understandable. However, the story gets a bit more concerning when we look at net income. For the first half of 2025, net income was $329 million in the first half of 2024. That's almost a 20% drop, which means for every dollar of sales, they're making less profit than before. That's something to keep an eye on. And what's contributing to this drop in profitability? Well, you can see a significant jump in selling general and administrative expenses. These are the costs of running the business, like marketing salaries and office costs. For the first half of 2025, these expenses were $38 million, up from $441 million in the same period last year. That's a 22% increase. And the report tells us this is largely due to costs associated with becoming a standalone company, things like professional services, rebranding, and IT upgrades. They also track something called adjusted EBITDA margin, which is a way to measure profitability before certain one-time costs. For the first half of 2025, this margin was 21.9%, down from 23.8% in the first half of 2024. This means their core business operations are generating less profit relative to their sales than they did last year. Now let's break it down by their two main business areas, the building materials segment, which includes things like cement and aggregates, and the building envelope segment, which covers roofing and wall systems. The building materials segment, which is their bigger breadwinner, saw revenues drop by about 3.2% for the first half of 2025 compared to last year. This was mainly because of lower sales volumes, partly due to bad weather and a weaker housing market. Digging deeper into building materials, cement revenues alone dropped by 7.4% to $1.9 billion for the first half. Their cement volumes were down nearly 9%, which means they sold a lot less cement. While the price per ton of cement did go up slightly, that wasn't enough to offset the significant drop in sales volume. And it's a similar story for aggregates and other construction materials. Their volumes were down almost 6% for the first half of the year, even though the price per ton increased by over 7%. So less product being sold is a clear trend here. On the other hand, their building envelope segment showed a slight revenue increase of about 0.6% for the first half of 2025 compared to last year, reaching $1.7 billion. This growth was partly thanks to an acquisition they made. But here's a really important number to look at: cash flow from operations. For the first 6 months of 2025, Amrize actually used $450 million in cash just to run their operations. That's a huge jump from the $68 million they used in the same period last year. This basically means they're burning through cash much faster now that they're on their own. A big reason for this jump, as the report points out, is a significant increase in their accounts receivable, which suggests they're taking longer to collect money from customers, and also higher payments to their former parent company, Holcim, as part of the spin-off separation. But let's talk about debt. As of June 30, 2025, Amrize had about $6.2 billion in principal on short-term and long-term debt. That's a massive amount of money they owe. They've been busy refinancing and taking on new debt as part of their independence journey. For the first half of 2025 alone, they took on new debt proceeds of over $3.3 billion from what they call senior unsecured notes. When a company goes through a spin-off like this, it's common to see adjustments in how they manage their employees and executive compensation. They've established new incentive plans for employees, which is a standard move to keep talent motivated as an independent company. Now, there's a concerning note here about their internal controls over financial reporting. They acknowledge a material weakness, which essentially means there's a significant risk that financial misstatements could go undetected. They attribute this to not having enough experienced accounting and supervisory staff. They are working on fixing this by hiring more people and using outside consultants. But it's a clear red flag for a newly public company. Looking at the overall picture, Amrize is facing a challenging market. Construction activity is slowing down, partly due to economic conditions, and sometimes bad weather can really impact their business. They're feeling the pinch with lower sales volumes, especially in their building material segment, as we saw with cement and aggregates. Their profitability, as measured by adjusted EBITDA, has also declined. For the first half of 2025, it was $1.16 billion, down from $1.28 billion last year. This indicates that even before accounting for all the one-time costs, their core business is less profitable on a relative basis than it was. When it comes to their ability to pay their bills and fund operations, Amrize has about $601 million in cash and cash equivalents as of June 30, 2025. This is down significantly from $1.5 billion at the end of 2024, again showing they are using up their cash reserves perhaps to fund operations or pay down debt. They do have significant credit facilities in place, like a $2 billion revolving credit facility, but the increasing debt levels and declining profitability combined with potential control issues are definitely points of concern for investors. So what's my take on Amrize? It seems like they're navigating a tough transition. The spin-off from Holcim has clearly created some operational and financial headwinds. Revenues have dipped slightly, and more importantly, profitability and cash flow from operations have taken a noticeable hit. The increase in SG expenses and the persistent weakness in cement and aggregate volumes are worrying signs. While they're trying to grow their building envelope business and make acquisitions, the overall market conditions and their internal control weaknesses suggest a bumpy road ahead. Investors will likely be watching very closely to see if they can turn these trends around and prove they are a viable independent company. Alright, that's our breakdown of Amrize's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Lots of great conversations happening there. Thanks for watching. See you next time.